Every now and again, it's good practice to check how your investments are doing and to see if there's anything else that you can do. For instance, from time to time, you may seek to rebalance your portfolio proportions to check that they're in line with your risk profile. Or you might check for better cash interest rates and move your money for better returns. However, it is often the case that investors and savers don't understand the tax measures that they should be taking to stop their investments from being eroded away, and often fail to make proper arrangements to keep their tax bill as low as possible. This video looks at 7 simple things to check to help you be more tax efficient and therefore increase the growth of your savings and investments. So let's start off with the first one, which is, are you making use of ISAs? One of the simplest ways to shield your money from tax is to use ISAs to hold your investments and money. This table shows you the personal tax allowances that you have, and these have reduced significantly over the past few years, with it now being a lot easier for your money to fall into a taxable bracket. But did you know that each financial year you can invest up to £20,000 across the different types of ISA accounts? And there are 4 types of ISA account in total for adults. For instance, you could put £10,000 away into a stocks and shares ISA and the other £10,000 into a cash ISA. This money can then grow tax-free on anything that you earn above your personal tax allowances on things such as dividends, interest and capital gains. And capital gains tax could be applied to any profits that you made on stocks and shares above that allowance that you've been given, if sat outside an ISA. But you can't carry this £20,000 allowance over from one tax year into another, and if you don't use it in a tax year, then you lose it. Do you already have an ISA? If so, then seek to use up your allowance for this year if you haven't already done so. As with those decreasing personal tax allowances and higher interest rates, you have a greater chance of paying tax on your savings and investments. If you haven't already got one, then they're very easy to open, and you can open up a stocks and shares ISA and a cash ISA in the same tax year. And the next thing to consider is, are you making use of a pension? Savers and investors often have pensions or SIPPs in addition to ISAs, and saving money in pensions offers some fantastic tax benefits. But remember, if you are using a pension, then you will be locking your money away until the age of 55, which rises to 57 from April 2028. This shouldn't be a problem for most investors who are looking to build up a pension pot for retirement in any case. When you make a personal pension contribution, you get tax relief from the government, and for every £80 that you contribute, the government will top it up with £20. And if you have a workplace pension rather than a private pension, then that tax relief gets deducted at source, with pension contributions getting removed from your gross pay before any tax deductions are then made on that smaller remaining gross amount of your wages. If you are a higher taxpayer, then you can get an additional 20% tax relief, or 25% if you're an additional rate taxpayer, if you complete a tax return. So potentially, for every £60 you contribute, you get a £40 or even more top-up from the government. Just like ISAs, cash or investments within the pension are protected from tax on dividends, tax on interest and capital gains tax, enabling them to grow tax-free over the longer term. But whereas any money that you draw from your ISA is tax-free, you will still need to pay tax at your personal income tax rate when you draw money from your pension. But as a retiree, this rate of tax could well be lower than what it was when you were working. Pensions are a very good way of building wealth, no matter what rate of tax you pay. And getting that 40 or 45% tax relief as a higher rate or additional rate taxpayer makes even more sense, as this will help you to build wealth more rapidly. The next thing to consider is not directly linked to tax, but it is directly linked to pensions, so I thought I would add it in here. You can have multiple pensions, but it makes sense to have a workplace pension to take advantage of those mandatory employer contributions. Some employers might even match what you put into your pension, but as a minimum, employers have to contribute 3% into your workplace pension on top of the 5% that you contribute. That 3% is free money, so even if you have your own private pension or SIPP, you should still consider opening a workplace pension if you haven't already got one, even if just to take advantage of that 3% your employer has to contribute. And if you are enjoying this video and it is of use to you, then please consider hitting that like button, subscribing to my channel and to turn on notifications so that you'll be aware of when I post new content. The next thing to consider is when you've used up your pension and ISA allowances for the year, and that is to manage capital gains tax on the investments that you have outside these tax wrappers. In this financial year, 2024 to 2025, you can realise profits of up to £3,000 on stocks and shares without having any capital gains tax liability. But you cannot carry forward that £3,000 allowance into subsequent tax years. So it may make sense to make use of that allowance in the current tax year while you can. Obviously, to take money out of your investments annually could impact the long-term return of your capital, but you could have a larger capital gains tax bill down the line if you fail to utilise your annual allowance. So this is one for you to weigh up here. And the next thing to consider is in relation to your cash savings. Your personal savings allowance is how much interest you can earn on savings each year without having to pay tax. In this financial year, 2024 to 2025, as a basic rate taxpayer, you have a £1,000 allowance. That reduces to £500 for a higher rate taxpayer, and as an additional rate taxpayer, you don't have one. In the current environment of higher interest rates, you might want to check whether you're at risk of exceeding these limits and liable to pay tax. If so, then consider other ways to save and invest your money. And when it comes to cash savings, it's also worth considering whether you take out a fixed rate account or not, as you cannot carry over that personal interest allowance into subsequent years. So if fixing it for 2 or 3 years, you may have to pay more tax on a larger amount 2 to 3 years down the line when the maturity date comes along, and you will only have your current year's allowance to offset this. And getting away from fixed rate savings, holding money in easy access savings accounts is important to help with unexpected emergencies, instead of turning to short-term, expensive debt such as credit cards or overdrafts. Although advice on this varies a little, it is generally suggested that to plan for an income shock, you should keep back approximately 3 to 6 months worth of funds in an accessible account. And the sixth consideration is to consider which asset could cost you the most in tax. So this would apply if you've maxed out your £20,000 allowance and you now have assets or savings outside of those tax wrappers. For cash savings, for instance, as a basic rate taxpayer, you'd have a meagre £1,000 allowance, and anything over that would be charged at your basic tax rate of 20%. But if you're investing in stocks and shares as a basic rate taxpayer, you have a larger £3,000 allowance for capital gains tax, and anything exceeding that allowance would only be charged at 10%. It could therefore be more efficient to move your cash into stocks and shares. Stocks and shares also provide you with a better opportunity to get higher growth over a longer term. That is, if you can stomach the high volatility that comes with the territory. Although investments fluctuate and you may get back less than you put in, history shows that patient investors tend to be rewarded for that extra risk. Just be careful that any capital gains that you do make does not push you into the higher rate tax bracket, as you would add capital gains to your income to work out your personal rate of tax. And number 7, the final consideration, is are you making use of your spouse's allowances? If you're married or in a civil partnership, it can make sense to arrange your finances as a couple rather than going it alone. As a couple, you have 2 ISA allowances, 2 pension allowances, 2 capital gains allowances, 2 personal interest allowances and 2 dividend tax allowances. And spouses or civil partners can transfer funds between each other without paying tax. This might come in handy if one partner is a higher rate taxpayer and the other is a basic rate taxpayer. By transferring certain assets into the basic rate taxpayer's name, you could benefit from lower rates of tax on income and capital gains. If you are unsure of anything tax related, please consider seeking the advice of a suitably qualified professional. Remember that paying more tax than you need to be paying could have a significant impact on what you are trying to achieve and what your future financial goals are. This next video looks at some Vanguard Global funds, which could help you with your research when deciding on what to put into your stocks and shares ISA or pension. Thanks once again for watching.